morning, Monaco. Welcome on Channel 5. You are watching Finance IOM, the TV show that cares about the health of your wealth. What's the most relevant topic than today's topic?
Tax shield!
So now let's introduce our guests. Let's applaud Miss Gelver and Mr. Silverstone, who are tax advisor at JP Morgan. Let's also welcome Miss Buronne, who is professor at the University of Monaco and also senior manager at KPMG. And finally, the last but not least, Mr. Nemitz. So before going into detail, let me introduce you what is tax shield. So tax shield is a tax benefit provided by allowable deduction. So companies and individuals can, from different operations, reduce their taxable income. Corporate level, to optimize the tax shield, the company needs to consider both corporate tax and personal tax. So please, Ms. Gelner, could you explain us what are the different methods of the company to reduce the tax income?
Of course, with pleasure. The first option to increase tax shield is trade-off theory, that is a subject of capital structure. The capital structure is the main subject of company because it explains how the company finances its investment and assets, either by debt or by equity, and in which proportion. And this proportion very often calculated by debt to equity ratio. So the low leverage means that the company is mostly financed by equity rated by the debt. And the higher leverage means that the company is financed mostly by the debt than by the equity. So there is a famous approach to capital structure called Modigliani-Miller theorem, or M&M theorem, that consists of two assumptions. The first one that states that there is no taxes, and the second one states that there is taxes in the real world. So the first assumption assumes that there are no taxes, no bankruptcy costs, no transaction costs, and no recognition of benefit from the debt. And it states that the capital structure and value of the company are not correlated at all, and leverage doesn't increase the cost of capital, as well as their debt holders and equity shareholders has the same priority. So the second proposition, which is also on the assumption that there is no taxes, explains that the leverage has a direct influence of the cost of equity. So it states that debt has a superior claim to the earnings than equity, and thus the debt has a lower cost than equity. So there, finally, the other proposition of M&M theorem, it's that in fact in real world we have the company has different taxes, so we must recognize the benefit from the debt. Therefore, trade-off theorem is based on the work of M&M theorem and is a trade-off between tax savings and district cost of debt. This theorem states that there's an advantage for companies to finance its investments, operations and assets by debt because there's a lot of benefits from tax deduction of investment payments. So the following graph shows us the relationship between the debt and the benefit. Increase in debt increase the firm value because the additional benefit is bigger than the cost.
However, at the point when firm value is maximized and reached its optimal debt ratio, the additional of new debt will start to decrease the value of the company and increase the risk of bankruptcy.
Therefore, trade-off theorem is trying to find the most optimal way of allocation between debt and equity, where decrease in WACC compensate the increase in risk in financial risk in the company.
So thank you, Ms. Gelver. Maybe Mr. Silverstone could help us and give us some advice also?
Absolutely. So another very imperative corporate tax shield is the depreciation tax shield. The depreciation tax shield is a tax reduction technique under which depreciation expenses are subtracted from the taxable income. The effective tax shield depends on the applicable corporate tax rate multiplied by the depreciation amount. So, for example, if you have a corporate tax rate of 33% and you're using the straight line method, just acquired an asset of 1 million and you're going to depreciate it over 10 years, you have a yearly depreciation of 100,000. So this 100,000 times the 33% equals 33,000 as the depreciation tax shield. When utilizing the depreciation tax shield, companies should consider to use the accelerated depreciation Contrary to the straight line method, this approach allows the taxpayer to recognize larger amount of depreciation in the first years of the life of the asset, and less depreciation later on in the life of the asset. Utilizing the accelerated depreciation, the taxpayer effectively defers the recognition of taxable income until later on in the asset's lifespan. If a company is not producing sufficient taxable profits at the time of having to acquire an asset, it will not be able to take immediate advantage of the depreciation tax shield, as there are no taxable income to shield. An idea would be for the corporation to lease an asset instead, as this could lead to other financial benefits. The use of the depreciation tax shield is thus more applicable for asset-intensive industries, where there are large amount of fixed assets that can be depreciated. Furthermore, there are different local laws and regulations in regards to depreciation as a tax shield, and companies need to be careful and know the laws in the different jurisdictions. So, in addition to depreciation as a tax shield, another and very important one, and probably the largest tax shield, stems from the base erosion and profit shifting that comes from multinational corporations setting off offshore subsidiaries in low tax jurisdictions. As most large companies today are multinational companies, they depend on international tax laws. However, these laws are mostly based on the basic tax laws allocating between source country and resident country. This works in a simple world, but in the 21st century today, where you have e-commerce, multiple countries operation, and you also have intergroup trade, is not sufficient anymore. So a real life example could be Starbucks, for example. So Starbucks from the US transfers its international property rights to an opaque European subsidiary located in Luxembourg. This subsidiary wholly owns other European affiliates of Starbucks and provides them with loans to start their operations and also international property rights to use their logos. In return, it receives interest and royalty payments. These interest payments and royalty payments are used as interest tax shields from the affiliates, thereby minimizing the taxation in the source country. In Luxembourg, the subsidiary is facing a corporate tax rate of 29%. However, this corporate tax rate is exempt by 80% if it comes from international property rights, which is thus allowing Starbucks to have an effective corporate tax rate in Luxembourg of 6%. So in order to fight this base erosion and profit shifting, the OECD have initiated an action plan of 15 action points in order to align international tax law on multinational corporation. As the increased use of base erosion and profit shifting is a great risk to the revenue stream of countries, the fairness of competition, and furthermore it distorts the competition and investment decisions if companies decide to do business based on tax instead of general business consideration.
So thank you, Mr. Silverstone, and maybe Mr. Buronnet, could you explain us how to compute this tax?
Thank you very much. I'm very happy to be here. So now let's look to a real example. This is an example based on Ansaldo Signaling and Transportation System. Is an Italian transportation company with a global presence in the field of railway signaling. It is headquartered in Genova and controlled by Hitachi Group, and also the company is listed in the FTSE/MIB Italian Mid-Cap Index. So this is a real example of how a company that is not producing sufficient taxable profit can increase its income. So at the time that the decision to acquire or to lease a good or whatever they need for their production has to be taken, they can immediately take advantage of the available capital stock. For Ansaldo, leasing will be an attractive alternative to buy because it's in the nature of this company to deal with long-term contracts that need a different type of property, plant and equipment. So using lease, the lessor with adequate profit is able to pass on the benefits of capital allowance in the form of lower lease payments. So, this was the situation when leasing first were implemented and rapidly rose in their popularity. Because as a consequence, many banks set up leasing subsidiaries to improve profitability by taking advantage of the capital allowance. So let's look at the 2015 consolidated income statement of the entity. As you can see on the left side, we have the current situation of the company, while on the right side, we have a projected scenario assuming that the company has no leasing contract, but they just buy everything that they need. The result, as you can see, is an increase in the amount of depreciation due to the fact that now the corresponding amount of the operating leasing must be depreciated too. There is also a lower amount of financial expenses, as you can see, due to the fact that if you purchase something, you don't have to pay the interest on the leasing contract. As a consequence, the pre-tax income is lower, so it means that the amount of tax that the company has to pay is lower too. As we can see, the result for Ansaldo is that with the leasing contract they can obtain a better result in terms of profit in the year than purchasing the goods that they need for their contracts. Also, the weighted average cost of capital of the company is lower because the market value of the debt, as we can see, is lower too.
So now we have a great understanding about the corporate tax shield, but let's remind you that to optimize the tax shield we also need to consider the personal tax. The personal tax is the tax applied to the source of revenue of the shareholder. The source of revenue are dividends, interest received from debt and capital gains. So the source of revenue have two taxations, one from the earning before tax and the other one from the earning distributed as dividends. So to conclude, the personal tax negatively affects the source of revenue of shareholder, and bigger is the personal tax, lower is the revenue and lower is the tax shield benefit.
So up until now, we merely spoke about the possible problems that arise in practice when dealing with the tax shield. First of all, there are several drawbacks in the Miller and Modigliani theorem. In contrast to reality, the model assumes there is an absence of agency costs, transaction costs and bankruptcy costs. In reality, these costs occur in the markets. Moreover, it takes not asymmetric information into consideration. Further, the assumption of market efficiency and the homogeneous expectations as well as the rational behavior of the market participants are questionable presumptions. From a practical point of view, when it comes to computing the weighted average cost of capital, we often simplify by only using one tax rate. In reality, as we saw before and Mr. Silverstone explained to us, we face with international operating firms that are confronted with multiple tax rates in different regions. Using only one effective tax rate on the one hand facilitates the usage of the WACC. However, users have to be aware that the WACC might be influenced by multiple and changing tax regimes in the world and take their impacts into consideration. Also, negative incomes limit the capability of computing a WACC. Besides shifting profits to other countries, different repayment patterns in debt capital fundings lead to varying interest rate payments and therefore different tax shield recognitions. Also, the asset depreciation based tax shield might make the tax shield subject of manipulations. Corporations can adjust their earnings by choosing the best fitting depreciation patterns or debt repayment schedules. In connection with that, the favorable tax treatment of debt offers opportunities for corporate groups to pursue debt shifting strategies to minimize their total tax burden. Time path of tax shield and the regional shift in operations can distort the allocation efficiency. Capital budgeting might be influenced by the tax deductibility, as projects might be profitable and worth for undertaking only because of the tax shield. However, in the absence of a tax shield, those projects would not be promising. The most striking matter with regard to the tax shield is actually the rational discrimination between debt and equity. According to the M&M theorem described by Ms. Galver before, the debt financing provides a tax shield and is thus cheaper until a certain risk level. So that means that the WACC actually decreases but is limited up to the point where the marginal cost equals the marginal benefit of the debt. Consequently, the leverage increases the company's risk level. A company is more sensitive to the economic downturns, to interest rate variability, and also to changes in market conditions. The company, on the one hand, is more risky, but also gets kind of restricted by, for instance, the disciplinary tool of loan and credit agreements such as covenants, assets used as collaterals. Taxation systems therefore promote debt financing and contribute to the extent of debt use, which is consequently adding risks. This could also lead to the attraction for mezzanine capital. Empirical evidence show that in practice, financing decisions are based on taxes. It might enhance the usage of mezzanine capital, thus it provides characteristics of debt such as interest payments that are tax deductible, but also in kind of the bankruptcy risks, characteristics that are common for equity.
So thank you for watching us on Channel 5. If you have any question, feel free to ask the question on our forum, and I see you next week on Sunday at 10:30. And now I'll leave you with Xenia, who will present you the meteor.
So today Monaco is very sunny, as you can see.
Of capital allowance, how is pronunciated?
So thank you for watching us